Let's go to Scentre Group, the owner of the Westfield shopping centres in Australia and New Zealand. And this, Ed, really is a litmus test for consumer demand and inflation again.
Absolutely, Ross. Look, net profit at Scentre Group, it did slip about 66%, but that was really due to some financial derivative changes. Revenue was up almost 8%. The dividend was higher too. Scentre Group provided guidance for the first time since the pandemic, and it's expecting to grow its earnings and lift the dividend again this year. So, Ingrid, what was the share reaction?
Well, looking at the shares, they were up around, you can see 3.5% at the end of the session, very comfortably beating the market after upping its distribution guidance. And Ed, you spoke with Chief Executive Elliott Rusano a short time ago.
Elliott Rusano, look, thanks so much for your time. Let's start off with customer visits, up to 480 million during the year, record number of leases signed. So despite the economic uncertainty, it looks like it was a pretty strong year for Scentre Group.
Well, thank you for having me on your program today. 22 was a great year for us. As you said, we had 480 million customer visits. It's an increase of 67 million customer visits on the year 2021. That momentum has continued into January and the first 7 weeks of 2023. We signed a record number of leasing deals during the course of last year. In fact, our business partners achieved $26.7 billion of sales through the Westfield destinations in 2022, which is a record for Westfield as a brand in Australia and New Zealand. So our business partners performed very, very well. That continued again in January of 2023. So that allowed us to deliver a profit growth of 20.6%, an increase in distribution, but importantly, we've been able to guide to growth in profits and distribution for 2023.
Yes, so you're providing guidance again after a couple of years, obviously, over the pandemic?
Yeah, so I think during the pandemic, it was very difficult to provide long-term outlook or forecasts for our business. Obviously, we've been through a period where various regulations came in regarding the movement of people, our ability to collect rent, but we're now through to the other side of that, and we're seeing the benefits of driving customer visitations, of the productivity of our business partners in our destinations, and that's given us comfort to be able to guide to what we see is strong conditions continuing. People are returning back to our destinations. So far this year, in the first 7 weeks, we've seen 70 million customer visits, which is 10 million more than in 2022 in the same period. Business partner sales for the month of January were 21% higher than in January 22, and importantly 11% higher than in 2019. And so the momentum that we saw through the course of 22 has continued in the early part of 23, and that gives us confidence to guide to profit growth of between 3.4 and 5.9% for 2023.
We know interest rates are going to continue rising though, so when are you expecting the consumers to potentially start cutting back a bit on their expenses and stop spending as much money?
Yeah, so I think that there's many factors that go into what drives customer behaviour. We know that there's increasing interest rates and cost of living pressures, but there's also very high levels of employment. Wages growth continues. Importantly, savings. Australians accumulated a lot of savings during the pandemic period. I think some $358 billion of savings were added to households. Savings rate continues to be positive. So there's a number of factors that go into what drives a customer. Our job is to actually drive the customer to spend time with us, and that has been a deliberate focus. We do that through what goes on in our destinations. We held some 15,400 in-centre activations during the course of 2022, which drove those customer visits to 480 million and the retail sales or business partner sales to 26.7 billion. And today we announced the collaboration with Disney to help them celebrate their 100th anniversary, again through centre activations, giving people a reason to come and spend time with us. And we've seen the benefits of that in the first 7 weeks of this year. And through that focus on giving people a reason to spend more time with us more often and for longer, we believe that our business will perform very well during the course of 2023.
Yeah, I know you signed up 288 leases with new brands to your portfolio. Those brands, are they part of that new sort of customer experience direction, entertainment direction, rather than just a straight retail outlet?
Yeah, so we have seen a shift over many years towards what we call consume on-site or more experiential forms of consumption. The 288 are new brands to our business, to our destinations. A number of them are in categories which are growth frontiers for us. So food, entertainment, lifestyle, but also medical and health. And Really, our role is we operate 42 destinations in close proximity to 20 million people, and our job is to broaden the reasons why people come and spend their time with us. And so we're constantly adapting what occurs in our destinations to give people that reason to spend their time with us, because we know that the more time people do spend with us, the more opportunity we're able to provide other businesses to interact with those people, which they had done over 2022 and have done in the early part of 2023. But importantly, they've done that over 60 years that Westfield has operated as a brand in Australia. And we believe that that growth will continue as we provide people with more of a reason why they should spend their time at a Westfield destination.